Every single company, from a tiny startup in a garage to a massive global corporation, eventually hits the same point. They need money to grow. But where does that cash come from? Today, we're going to break down the ultimate choice every business has to make. Should they borrow money? Or should they sell a piece of themselves?
So let's just start with this central problem, right? You've got a fantastic company, great product, great team, but building a new factory, launching a new marketing campaign, or just hiring more people, all of that costs money. That capital has to come from somewhere. So really, what are the options on the table?
When you boil it all down, there are really two main paths a company can take. The first one is debt financing, which is basically just borrowing money. The second is equity financing, which means selling off a percentage of the company to investors. So you can think of it like this. Are you going to take out a loan, or are you going to sell a slice of the pie?
Okay, let's dive into that first option, the world of debt. For a lot of companies, this is the first place they look for cash, but it definitely comes with its own very strict set of rules and risks.
Now, the deal with debt seems pretty simple on the surface. You get a lump sum of cash right now, and you sign on the dotted line promising to pay it all back later, plus interest, of course. But here is the most important part. As long as you make those payments on time, you and the other original owners keep 100% control. The lenders don't get to tell you how to run your business.
So how do companies actually do this in the real world? Well, while there are a bunch of different ways, it usually boils down to one of two things. Either getting a good old-fashioned loan from a bank or issuing something called corporate bonds directly to investors.
A corporate bond is really just a loan that's been packaged up in a way that lots of people can participate in. Instead of borrowing from just one bank, the company is borrowing smaller amounts from maybe thousands of different investors. In exchange, the company promises to make these regular, fixed interest payments, those are called coupon payments, and then, on a specific date in the future, they pay back the original loan amount.
What's so powerful about this is just how predictable it all is. It's a rock-solid contract. An investor gives the company cash, and the company provides a steady, reliable stream of payments back. There's no drama, no surprises, which is exactly what people who invest in debt are looking for.
However, especially when it comes to bank loans, things aren't always as straightforward as they seem. Sometimes, there are some tricky strings attached that can completely change the real cost of borrowing.
Let's just walk through an example. So a bank might come to a company and offer them a loan with what looks like a pretty sweet deal, a 9% interest rate. On paper, that looks great.
But what if the bank throws in a little clause called a compensating balance? This is a sneaky requirement that says the company has to keep, say, 20% of the loan money just sitting in an account at that bank, earning zero interest. All of a sudden, the company can't even use all the money it borrowed. So the actual cost of the money it can use just shot way up, in this case to over 11%. That is a very real and very hidden cost.
So here's the bottom line on debt. The pros are huge. You keep complete control, and you get a nice tax benefit because interest payments are a business expense. But the cons are serious. Those payments are mandatory. Debt doesn't care if you had a record-breaking quarter or a disastrous one. The bill is due, period.
Okay, let's totally switch gears and look at the other side of the coin, equity financing. This is the one you always hear about when a hot new startup raises millions of dollars or a company goes public on the stock market. And it's a completely different way of thinking.
See, with equity, the company isn't borrowing anything at all. It is literally trading a piece of its future for cash today. Investors hand over money, and in return, they get shares of ownership. And here's the absolute game changer. That money never has to be paid back. And that is the fundamental bargain here. These new investors are now partners. They're part owners. They get to share in the enormous upside if the company succeeds, but they also have to share in the risk if it fails. They're not just lenders. Their financial fate is now tied directly to the company's performance. The most common way this happens is through, well, common stock. And that stock comes with real power. We're talking about voting rights, and they are not just symbolic. Shareholders get to vote on who sits on the board of directors, on huge strategic decisions, even on how much the CEO gets paid. They are truly owners with a real say in where the company is headed.
So, the single biggest advantage of equity is the flexibility. You don't have those mandatory monthly payments, which dramatically lowers the risk of going bankrupt, but that flexibility comes at a huge price. First, the founder's ownership stake gets diluted. Their piece of the pie gets smaller. And second, it's generally the most expensive way to raise money. Why? Because equity investors are taking the most risk. If things go bad, they get paid last, so they demand the highest possible return for that risk.
And this just lays out the fundamental conflict perfectly. Debt holders are basically lenders. They get no control, no voting rights, but they have a legal priority. They are first in line to get their money back. Stockholders, on the other hand, are the owners. They get all the control, but they only get what's left over after everyone else, especially those debt holders, has been paid in full.
So you're facing this impossible choice, right? The rigid, risky obligation of debt versus giving up ownership and control with equity. But what if you could kind of blur those lines? What if you could create something that gives you the best of both worlds? Well, this is where financial engineering gets really creative.
Take the convertible bond, for example. It's like a financial chameleon. It's such a genius idea because it appeals to everyone. The company gets to issue debt, but at a lower interest rate than normal because it's offering this potential upside. And the investor? They get the safety of a bond with guaranteed payments, but they're also holding a lottery ticket. If the company's stock suddenly takes off, they can convert their bond into stock and cash in on all that success. It's basically debt with an equity escape hatch.
So you've got these options on the table: plain old debt, pure equity, and these clever hybrids in between. But what do real companies actually do? When it really comes down to it, is there a predictable pattern?
Well, it turns out, after decades of research, the answer is a resounding yes. There's a clear pattern, and it's so consistent it actually has a name. It's called the pecking order theory.
And here's the really fascinating part. The number one choice for companies that need cash is none of the options we've talked about. They would much rather use their own money first, the profits they've already earned and saved up. Only when that runs out do they turn to debt. And selling ownership by issuing new stock? That is almost always the absolute last resort.
And that, of course, raises the final critical question. Why? Why are managers and founders so allergic to selling shares in the companies they run, even when it seems like the safest, most flexible option?
It all comes back to those two core trade-offs we've been hitting on. As we mentioned, it is usually the most expensive form of capital. But more importantly, it permanently dilutes control. And for the founders and executives who built the company from scratch, that is often a price that's just too high to pay. So at the end of the day, this choice between debt and equity is never just about the money. It is a constant, high-stakes balancing act between risk, reward, and control.